In this video, I want to walk through some of the shareholder letter for Lemonade Q4 2021, look at some highlights, at least for myself, share some of my thoughts after reading the letter, and try and answer the question, is Lemonade a company that is going to go bankrupt, or are they still have a chance of being successful? And try and answer that question for you guys, at least from what we see in the letter. I see the stock is getting absolutely crushed after hours, and a lot of negative people just dunking on the company right now online, talking about it. So sort of share my thoughts all around that question, so stay tuned for that. Okay, Lemonade shareholder Q4 2021. Let's dive into the letter here, at least some of my highlights. The big numbers here at the top of the letter. So $380 million in-force premium, up 78% year over year. $266 premium per customer, again up 25% year over year. Up to 1.4 million customers they're at approximately now. Again, the end of Q4, their gross earned premium, which is your sort of the amount of in-force premium that comes to the end of its term, and then it can be kind of deemed earned premium. So that's at 89 million, 79% year over year. So that it generally trails or very close to sort of a year over year metric. Same sort of growth story as your in-force premium, very similar because just sort of a trailing metric in quantity to your in-force premium. And then your gross loss ratio. This is where a lot of people are concerned. Pretty bad is they're not even pretty bad, very bad. Their gross loss ratio up 23 percentage points year over year, up to 96%. This is the amount of loss you have for amount of premium, your gross earned premium that you make. So the amount, almost all the money is being paid, that's being brought in, is being paid out in losses for insurance claims. So very bad, very, very bad. But we're going to talk about that here in the video. So, okay, first highlight here, I wanted to bring up one little paragraph in their management analysis and remarks here. They talked about their premium per customer growing $53 in 2021 and was significantly higher than the year's prior's growth of $36 of growth, and which was a record year in itself. And we expect to beat this record again and again in coming years as newer products and the resultant bundles we can offer buoy this metric. So their overall percentage may or may not increase or decrease depending on how much it can accelerate, but the actual dollar amount they are suggesting should continue to accelerate in premium per customer, which makes total sense, something I've been talking about a lot, as more higher dollar value products like especially car insurance is rolled out US wide and then even to other countries eventually, and then more also customers that have access to maybe only a renter's insurance now can buy their car, but also can buy renters and their car, or homeowners insurance and their car. So just have more products available is going to significantly increase your premium per customer. So it makes sense, and they're just sort of reiterating that here. And they kind of go into another highlight, their S1 sort of overall strategy. I'm not going to read this all, but they say it was twofold: win with technology and then grow with our customers. And they kind of talk about here, and I feel like they're kind of foreshadowing or getting people ready, reading this letter, talking about the loss ratio, saying that really what we've been focused on so far is rolling out the sort of foundations, rolling out the new products, which I think is true. And now, then they're sort of talking in here that this means they're sort of at a point, a critical mass of both, where they have enough new products, new technologies for many years. They will continue to develop new products, new technologies for many years to come. For the first time, we believe we reach a critical mass of both, enabling us to shift resources to harnessing our technology and products in new ways. This means leveraging our technology to lower expense ratios through automation, low loss ratio through machine learning, while growing long-term value to or lifetime value to customer acquisition costs through cross-selling and bundling. So, you get what they're saying here, like they're going to fine-tune things are going to be bundled more, which should, like we've been saying for a long time, should make things more efficient, more much better unit economics. But you also kind of have to wonder, okay, why is the loss ratio spiking right now? Again, we'll talk about that in more detail shortly. But you kind of wonder, couldn't you have been doing those things at the same time, harnessing your technology, leveraging your technology to lower expense ratios through automation? I mean, they've already talked about in previous years how that they are very automated, and they've showed data not recently, but in several years ago, that's 2017, 18, they released data that showed their sort of policies per human that they could handle was much higher than other insurers. So it's kind of like, yeah, I get it. They have to keep improving. They must keep improving these things if they want to be successful or have a chance of succeeding, having that binary outcome of 1 instead of 0, or outcome of huge success instead of failure or bankruptcy. But kind of odd, like almost like they're just buying themselves times here with this note here. Okay, and and again, they talk about those investments have taken a backseat to new product launches. And again, that makes sense too. They've got all kinds of new products rolling out. So now they're really saying they're shifting to these next quarters, years, to take the business to the new levels of efficiency, growth, and profitability. Okay, that's great, because I've said for a while, it's my say earnings question on the say platform. I expect to be answered tomorrow as I try and directly ask, when do they really expect, approximately when do they think they could turn to profitability? And this line at the end here I found really stood out to me. Indeed, 2022 is expected to be our year of peak losses. Stood out to me because I kind of took it as, okay, really they're thinking this is going to be the worst year, the biggest loss, and then the overall unit economics should start to take a shift, especially as Lemonade Car goes U.S. wide, or virtually everywhere in the U.S., that they could see major shifts in their unit economics. And then maybe 2023 is still a year of loss, but less loss than 2022. And then maybe 2024 is still maybe a year of loss, but maybe it's a much smaller loss. And maybe 2025 is a year of significant profits, and then profits fueling other growth. And then beyond that, massive growth. So that's how I kind of took to reading this. Actually kind of encouraged that 2022, this is kind of the worst year, and then they should start to see a reversal, and rather than losses growing quarter over quarter or year over year, should actually see them leveling off and then improving to profitability. Maybe they're also put this in here just to sort of prepare investors for this year. Either way, so a couple thoughts there about that. Okay, now let's talk about the loss ratio. Our Q4 21 gross loss ratio was 96%, up from 73% a year ago, and the third quarter of 77%. Meaningful driver of the sequential increase is an unfavorable prior period development due to a handful of older, larger losses for which we under-reserved. Notably, there was no spike in our accident quarter loss ratio from Q3 to Q4. Okay, that's such a mouthful to read, but if you look at, I'm just going to flip over here, the gross loss ratio they define as a percentage of, we express it as a percentage as the ratio of losses and loss adjustment expense to gross earned premium. I believe, I'm guessing loss adjustment expense, it'd be like previous quarter losses where they expected that they would pay out a certain amount for the claims they had in that quarter. But when those claims were finally settled, maybe the expenses were actually significantly higher. So then they add that into that quarter. That's kind of, I'm not exactly sure, but that's sort of my understanding, or at least my reading of that. So what I think they're trying to say here is that they had previous development, a handful of older large losses, which we under-reserved. So they sort of under-calculated how much they'd actually have to pay out at the time, or expected to pay out, and when times claims were really finalized and paid out, they were significantly higher, and then they booked those losses here in this quarter. That makes this quarter look significantly worse. Notably, they say there was no spike in our accident quarter loss ratio from Q3 to Q4. So I'm going to guess if you cut out those things they're adding in, these sort of older large large losses, it'd be more similar to the 77%. Still really concerning, though, that they're up 96% overall, when, they're a company that they should have, or a major question for them is, are they a better underwriter than a traditional insurance company could be? Are they a better underwriter? Do they have an underwriting advantage because they have this digital structure that's underneath them that can pull out nuanced data, that can know the Google search query that brought you to Lemonade, and whether you reread the fine print or not, and whether you booked it at 3 p.m. or 3 a.m. Those kind of little details, in theory, should have some slight underwriting advantage. Really have to see how that plays out. And you do have to give them credit, though. I think I'm not I'm not giving up on Lemonade yet at this point, because they do, as they sort of explain here below, they are rolling out a lot of products, a lot of new customers, pushing growth into these new products, and so I guess you might be expected to see loss ratios go up and down. Even Lemonade Car, as that rolls out, could push the loss ratio up or up higher temporarily, maybe, until they get a better wrap on how much they're charging customers for that product, and as they're growing out that product, right? And they go into a little more detail here. We understand our elevated loss ratios in recent quarters. We'd like to highlight a theme from last quarter's letter. Our business mix has evolved considerably since a year ago, with U.S.-based renters comprising less than half of the book, about relative to 2/3 of the book a year ago. So just renters insurance, which they had a better handle on, that product, a little more of a mature product, was 2/3 of their book, of their in-force premium a year ago, and now it's less than half. So other products like home and pet insurance are significantly growing, and so they say the lines of business that have captured that share, home and pet, demonstrate higher loss ratios than our more mature, stable renters book. So obviously, if these lines are growing significantly, and that's also hurting the loss ratio overall, then, and maybe there's major losses from home and pet in previous quarters that they weren't counting, now they counted into this quarter. Essentially, it must mean that home and pet have significantly higher loss ratios than the renter's insurance, maybe even above 100% for these ones, especially when you include these other sort of lumpy losses that came, these older large losses from previous quarters. So those have to get significantly better if they want to be successful. And then they go on, we have many ongoing projects across the organization to improve underwriting profitability in our newer lines of business, and these are yielding steady improvements in both home and pet loss ratios. Nevertheless, these improvements have been outpaced by these products' growth, meaning that our aggregate loss ratio has climbed even as our per product loss ratios have improved. That was a really interesting line. It says, so they do say, and I really wish they would release the per product loss ratios, because then you could see on a more mature product like a renter's insurance, are they continuing to fine tune, getting a percentage point better, quarter over quarter, year over year, with these more mature products. And it would be really interesting to see that on new products, you kind of help us understand how more lumpy they are when they start, and then maybe they improve over time. I wish they would release their per product loss ratios have improved. Maybe that'd be a great question to ask tomorrow on the earnings call, if one of the analysts would ask, or maybe I can try and prompt the company to do that. We'll see. But interesting, they're saying that the overall loss ratio has climbed, even though their per product loss ratios have improved. I'd love to see the graphs on each product. Would really love to see that. But according to what they're saying, those ones are still improving, but because the home and pet are so bad, overall is still getting worse. This puts us on a path to getting loss ratios of all Lemonade products to under 75%, but in the near term, it's possible to see quarters with loss ratios above this level as our newer lines mature. Again, maybe they roll out car insurance a year from now and they're at 100% loss ratio because they gave they underpriced their product, or their underwriting of the car, underestimated the risks of a certain driver, etc. This is to be expected and is natural and temporary cost of launching and scaling new products. And then we jump into their guidance. So I'm just looking at in-force premium as they're only expecting for this quarter 405 to 410 million. And for the full year, if you look at the full year 2022, this is kind of interesting. Please note we expect the Metro Mile transaction will close during Q2 and that our total annual in-force premium will grow approximately 70% during 2022. The guidance below, however, excludes expected impact of the closing of the Metro Mile acquisition. So it's a little bit confusing there. Even when I was first reading it, I'm thinking, okay, so does this doesn't include anything from the Metro Mile acquisition, or would? So in-force premium at December 31st, 530 to 540 million. But so it looks pretty low, and I'm just going to flip over here to show you on this marketing spend spreadsheet that I did in a previous video, added in some of the most current numbers. And if you assume 405 million, they get to, it's only a 25 million in-force premium gain, say by next quarter. So this would be Q1 of this quarter. It's only $25 million gain, or $25 million in-force premium gain, and then by the end of the year, they're talking 530 to 540 million. So not super high aggressive growth when you're thinking about car. If you say, maybe they grow 25 and then 25 again, and then car really kicks into a higher gear, and then they go 50, 55. It's like, well, that's okay, but not crazy growth, nothing really incredible. But if you look a little closer, that's what they're kind of saying without the Metro Mile acquisition. But if we go back here with the Metro Mile acquisition, they're thinking in-force premium will grow approximately 70% during 2022. So right now they're at 380 million in-force premium. If they're thinking it's going to grow 70%, just open calculator here. So 380 million multiply by, add 70% to that, and you're going to about 646 million of in-force premium. So really what they're thinking is more like 646 million if Metro Mile, everything goes smoothly there, that goes through. So significantly higher than this 540, and I feel like a lot of people probably miss that when they're looking at this guidance. So something to definitely consider there as well. For the call tomorrow, a couple thoughts here. I hope they answer my question on the earnings call. It's on the Say questions. I'll just hop over to that here and show you just to look at what Say questions are here. Mine has been, thank you everybody who's voted it up, is one of the highest voted for the Lemonade shares represented, at least one of my questions, which was how can Lemonade sustain rapid growth and cash burn for many years? How and approximately when do you see the switch to profitability happening? So I really hope, I think they will answer this, even if you switch to top voted, rather just number of votes rather than shares of votes. It's on the second question, and so I'm assuming, I think this question will be answered tomorrow, and just even as much as the answer they give, because I don't know if they'll really give a super detailed timeline, but even how they answer and kind of the confidence they show and reasoning behind that, I think is going to tell us a lot about, are they going to reach profitability or not? And in my mind, if they reach profitability, or even their losses start decreasing, and after this year getting better and better, and then they do become profitable, then Lemonade long term is going to be very, very successful. If they don't, if there's too many continued, there's just maybe more excuses or something comes in a year and you kind of kick the can down the road, then they could fail and definitely go bankrupt or become nearly worthless. And so I hope that question is answered. This is an interesting one too. This guy asks, why there hasn't been any insider buying while the stock has gone below the IPO price. So this is kind of a nice question. We'll maybe put them on the hot seat a little bit to see why they think about, even though the stock's so low, why hasn't there been any insider buying? He does ask, are there plans to initiate a buyback, or does the executive team have a price in mind for individual buys? I don't think they would do a buyback just because they're in such high growth mode. They have money on the balance sheet. They have to there's regulatory reasons that they need to hold about 1/7 of their in-force premium as cash, so I don't think they'll be doing a buyback. I wouldn't want them to, even at these low prices, just because it would kind of increase the risk. Then they would have to raise money later. But this is also interesting. Does the executive team have a price in mind for individual buys? So again, sort of more on an individual basis. What do they think about the stock price and their own personal money? So good question, but also I'm expecting them to answer this one and excited for that answer as well. And then I hope analysts ask about the per product loss ratios and why they don't publish those, and maybe more details on loss ratios of home and pet insurance and how those have trended over time would be really interesting question on that loss ratio side of things. Some closing thoughts too. I mean, Lemonade's always been a risky binary outcome company. Lots of people just, like I said at the start of the video, lots of people dunking on this company right now. I still think it could be successful. So to answer kind of the initial question, is this, is it game over for Lemonade? I think the market's overreacting right now. I think it's still, like I said, it could definitely fail. There's lots of possibilities where it fails, and for that reason, it's still a relatively small part of my portfolio relative to my Tesla holdings. But I still think it could be successful. I don't think there's the story kind of still adds up and makes sense. That they could be successful, and that's still definitely a possible and even probable outcome. And for myself, so because of that, I still may add gradually and slowly, and it has been my strategy all along. I really haven't dived all into this company. If I felt like, they're going to become profitable, I would buy more aggressively then if I really felt that was successful and people were missing that, especially. But for me, it's been more just very slowly, gradually adding, and at these really low prices, I think I will probably continue to do that, but no crazy amounts of buying. So that's sort of my thoughts on this quarter. Excited for the call tomorrow. I'll try and share some more thoughts around from that call. Let me know in the comments down below what you thought of Q4 2021 for Lemonade. Love to hear your comments. I read all of your comments, even if I can't reply to them all. So really appreciate each one of you and the feedback that you bring. You can also find me on Twitter at PaperBagInvest. Thank you so much for listening, for watching, and have a great day. Remember, it's in the bag.